Rick, as has now become a tradition on these calls, I'd like to kick off this discussion with several questions on the macro. If I was to turn the television set on mute today and just watch what was going on in the world around me, I would have thought that this would precisely be the environment in which precious metals would outperform everything else. It has been exactly the opposite now for a fairly extended period of time. The precious metals market continues to believe that we are headed into an environment of higher interest rates and tighter policies by the Fed. Now, the BOJ went into a zero interest rate policy world about 20 years ago, and the ECB went to a zero rate a decade ago, and neither of them were able to get out of that. The Fed has only been in this zero interest rate world for about a year now, and they're already talking about raising rates. Why do you think the precious metals market has got this so wrong, given the obvious consequences of rate hikes today?
I'm not sure that the precious metals market has gotten anything wrong. I think that there's often a delay between the existence of facts and the broader public acceptance of those facts. I think it's important to note, first of all, that we have been through the most benign economic climate in the history of mankind in the period 1982 to 2021, 2022. A period characterized by rapid improvements in efficiency wrought by technology, rapid improvements in global wealth, both as a consequence of the increase in trade among people and the liberalization of China and the general urbanization of frontier markets. Also by a dramatic lowering of interest rates and the cost of capital. It's important to note that the interest rate on the U.S. 10-year Treasury in 1981, 1982 was 15.5%, and it's all the way down to 1.2% now. The upshot of all of this is that 40 years of benign economic climate has caused people to be almost inured to fear, to believe, as an example, in the Greenspan put or the Merkel put or the Powell put, that whatever happens in equity markets or debt markets, that the Fed will conquer all. There has also been, as a consequence of falling price levels for 40 years, at least real price levels, the sense that inflation wasn't anything that we had to concern ourselves with. I would argue that all good things come to an end, and the declining cost of capital that we've seen as a function of the falling interest rates is such that while interest rates could fall a bit from here, having fallen from 15.5 to 1.2, I believe that the most important part of that fall is over. I would argue, too, that the returns that society has enjoyed from increasing efficiency, from technology, from urbanization, and from world trade is slowing, particularly slowing as a consequence of the consumption of an ever larger piece of productivity by government. And the very growth of government and the very growth in the reliance that increasing proportions of the population have means that the benefit that society has enjoyed over the last 40 years from things like urbanization and trade will begin to slow, which is a very long way of saying that the psyche of investors worldwide has been conditioned over 40 years and is backward-looking rather than forward-looking. Aditya, I agree with you completely that the macro thesis supports higher gold prices, and let's go through that. When I say gold prices, I'm using that as a sort of a catch-all phrase for precious metals investments. Precious metals investments do well when people are concerned about the purchasing power of their savings in conventional financial instruments denominated in fiat. Let's look at what might fuel those concerns. First of all, quantitative easing. We've talked about it before. If you and I did it, it would be called counterfeiting. It is, irrespective of what you talk about. The creation of specious currency units to inflate the economy rather than to accommodate the liquidity needs of a growing economy. It is, in fact, counterfeiting, and counterfeiting should make one nervous about the currency that's being counterfeited. The second is debt and deficits. We have no means of paying off the aggregate federal debt in the United States with our current budget, let alone unfunded private pension plans, state and as well as state and local debts. But the most pernicious and ironically the best for gold prices is negative real interest rates. Negative real interest rates are not a force of nature. They're an artificial construct. The idea that I forego consumption and lend you money so that you can consume now, and I take the credit risk as well as the interest rate risk, but I pay you to do it, is insane. And that's what negative real interest rates are about. And I would suggest that over time, the most broadly expressed concern about conventional savings products will be negative real interest rates, and that the beneficiary will be gold. Let's look on the other side of the trade, separate and apart from the fact that people have been conditioned for 40 years of benign economic climates not to feel fear. Let's look at the possible competitors against precious metals. Let's talk about the things that are perhaps consuming market share. For one, I don't believe that cryptocurrencies are particularly a concern because the size of that asset class relative to precious metals, and particularly relative to other elements in the society, is such that crypto competes with precious metals only at the speculative margin. Much more effective competitors, I think, are the S&P 500 and, to a different degree, technology stocks. Investors have come to believe after a 40-year equities bull market that the biggest and best companies in the world have pricing power and only get better and better and better. I believe that the principal competitor for precious metals in terms of investors' portfolio is in fact the S&P 500 and to a different degree the QQQ, although I don't think those investment groups are particularly analogous. And also among family office investors, I think there is a continuing sense that very high quality commercial real estate, where you are enjoying 2 or 3 or 4% annual increases in rents, while your cost of capital expressed by the 30-year mortgage is fixed. I think people believe that the delta in real estate, the delta between the cost of capital and the return on capital employed will increase, and that is also a viable hedge against inflation. And I agree to some extent with both strategies. Sorry for this long-winded answer, Aditya, but this is a very big question. I would point people who are concerned about competitive investment strategies to precious metals to visit the fact that precious metals and precious metals equity have a market share among savings and investment products in the United States of America of less than 0.5%, which is to say the total investment in the United States in precious metals and precious metals related investments is less than 0.5% of total investment in savings assets in the country. And that the 3-decade mean is believed to be between 1.5% and 2%. So I don't believe that gold has to overcome the S&P 500, and I don't believe that gold has to overcome the QQQ, and I don't believe that gold has to overcome the faith in commercial real estate as expressed by family offices and university endowments. I simply believe that gold has to lose less badly, which is precisely what I think is going to happen as a consequence of negative real interest rates, debt and deficits, and quantitative easing. Sorry for that answer, but I wanted to answer it completely.
Thanks for the answer. One of the questions that was sent in, and this is probably one of the questions I get asked the most by some of our existing clients, particularly those who came on board last summer when we did see a rally in the precious metals. what is that catalyst now for a reversion to mean in the ownership that you talk about? I mean, we're seeing persistent inflation. We're not seeing, the market is not slowing down, and growth expectations are still high. So, from your perspective, what do you think may be a catalyst for this reversion to mean going forward?
I think there's two. One is simple arithmetic, meaning that it will take place over time. People will come to recognize, first of all, that the Fed is unlikely to be able to allow interest rates to rise too much because there isn't sufficient strength in the economy to allow that to happen. The second thing is that there is always the possibility that some black swan style event, by its definition, one that nobody has thought of, could shake people's faith further in financial institutions. My suspicion, however, is that when one looks for a catalyst, one is engaged in a fruitless quest, which is to say, one should buy fact rather than opinion in any circumstance. The idea that the factors behind what I see as the inevitability, or at least the high probability of an increased precious metals price, the fact that all of those factors are intact at the same time that the price is decreased rather than increased should be viewed by investors as a good sign rather than a bad sign. If you want to be involved in an investment segment, if you want to add assets in that asset class and the price is falling, that's a good thing. If we were shopping for physical assets, this would be called a sale. And I don't think that there's anybody on the call who, when they're buying physical assets, wouldn't like to buy them on sale.
I've spent my entire career in the commodities space now, but my understanding of commodity cycles, particularly investing in them, have certainly been turned on its head over the last 12 months. A lot of commodities have moved from 5-year lows to 5-year highs now over a very compressed period of time. The equities in each of these commodities have also followed these moves. There's certainly a component of this that is being driven by liquidity and the liquidity in the markets today. But I also hear discussions being had about structural supply deficits that will sustain these prices going forward. I'd imagine that the current price levels would not be great for economic growth. In your opinion, do you see these trends as sustainable trends, and particularly for some of the economically sensitive commodities like energy, where we have had a big run-up? Do you see these prices holding over the next few years?
I think we need to have the discussion on a commodity by commodity basis. As an example, oil. While the oil price is substantially higher than it was 2 years ago, if you look at the oil price in a 10-year time frame or a 20-year time frame, the current price is not anomalously high. And I think that that's the time frame that you have to look at it in. The second thing is, in terms of an investment in oil equities, the oil price doesn't have to go up from here. In fact, it has to maintain at a level that's lower than the level that we're experiencing today for the equity prices of oil companies to be attractive. In other words, we don't need $125 oil in order to justify the purchase of, say, Exxon or Chevron or some lesser lights. What we are seeing, despite the relatively high prices for oil and gas, is a developing shortage of insurance capacity in the sector because of ESG and carbon-related concerns, a higher cost of capital, irrespective of the free cash generation of the companies in place, a market reduction in exploration and project development expenditures, and a reduction in sustaining capital investment, which means even though the industry is highly profitable at $80 a barrel, what we're seeing is a severe shortage of reinvestment of free cash flow or the investment of new cash flow, which is necessary to sustain production. Remember that the real production growth that we saw as an example in the last decade had an awful lot to do with unconventional production, which is at once very, very, very capital intensive and is also subjected to very rapid decline rates. And when I look at the energy business today in terms of investing in oil and gas equities or oil and gas debt, I see a circumstance where the oil price doesn't need to go up and the natural gas price almost certainly needs to come down. But it can come down substantially and still lend credence to the suggestion that oil equities are reasonably priced or in many cases cheap. And if on a worldwide basis the energy investment community doesn't begin the process urgently of new project investment and sustaining capital investment, I think you are going to see plus $125 oil. I hope we don't, but I think there's a very real risk of that. Similarly, and I know we're likely to get to uranium later in this call, the fact that the uranium price has cleaned up from mid-20s when we first started talking about it to mid-40s now, having briefly touched 50, is useful. And I think with regards to the uranium equities, particularly the juniors, the easy money has been made. But make no mistake, over the next 2 or 3 years, uranium prices must go higher in order to facilitate the electrification of the world and the maintenance of current levels of electricity generation, even in countries like the United States. It was estimated some time ago by the International Energy Agency that the total cost to produce a pound of uranium was between $55 and $65. Let's call it 60 per ton. It is true, too, and by the way, that's a total cost number, not all in sustaining capital or mine cost, but rather included general and administrative expense, exploration expense, development expense, and cost of capital. It is also true that inflation is taking a toll on the mining business worldwide, both in terms of new project development and in terms of operating costs, which means that that fully loaded cost of $60 is rising inexorably. It is true, too, Aditya, and the people on this call need to consider this, that to the extent that the uranium price or any other commodity price goes above the incentive price required for new production, that the production response to the price levels is slow. It isn't immediate. Permitting and developing a new uranium mine can take 10 to 15 years. And even restarting mines that have been well maintained on care and maintenance, like McArthur River or Cigar Lake, can take 2 years. Once you have ramped those up, it takes another year to turn the raw yellow cake into the customized fuel rods necessary to fuel a nuclear reactor. So even to the extent that the uranium price went to $65 tomorrow, that $65 price level tomorrow wouldn't result in a supply increase in the time that many people believe it can occur. The upshot of that is that very often in the transition from bear market to bull market, the commodity prices close substantially above the long-term incentive price, simply because the commodity price doesn't stimulate new production as quickly as one might hope it would. Again, sorry for the long-winded answer, but that's a very big question that you asked me.
There were a few points in there that I want to revisit. One of them is time frames. A lot of investors are looking at opportunity cost. They are not necessarily positioning their capital for things that will rise, in 4 or 5 years, even though, given the nature of these commodity cycles, that is probably the most prudent way of investing in the space. How do you look at opportunity cost as a resource investor when positioning your own capital, where certain themes may remain inactive for many years while other themes are going up. And so how do you view opportunity cost as a resource investor yourself?
I see sectors that are going up very rapidly as presenting a special risk. In the first instance, because of recency bias, people's expectation of the future is governed by their experience in the immediate past. I know, as an example, that interest in precious metals was especially acute a year and a half ago. So I regard a hot sector, one that exhibits rapid increases in share prices, as being particularly risky. The idea that rapidly raising prices gives me some sort of sense of psychological security is something that's been beaten out of me in 45 years in markets. I note that the longer an illogical circumstance exists, the closer it is to being over. If you look in particular at commodities pricing, what you will find in commodities equity pricing too is that very strong secular bull markets are punctuated by cyclical declines. Those cyclical declines can be shockingly long in terms of duration, a year and a half, 2 years, and shocking in terms of their dimension, 25 or 30%. The longer one of these cyclical declines lasts in a secular bull market, first of all, the closer you are to a conclusion, but more importantly, the more radical the correction is. For people on the call who have the advantage of not being as old as I am, let me share something with you. In the first gold bull market of my career, the 1970 and 1981 bull market, the initial phase of the bull market, 1970 to 1975, generated a really spectacular response. Gold rose from an admittedly price-controlled $35 an ounce to $200 an ounce. And of course, the very increase in price, while it made gold arithmetically less attractive, made it psychologically more attractive. And by the end of that 5-year period, gold had an awful lot of adherence. In 1975, interest rates rose, the dollar strengthened, and the gold price in U.S. dollar terms fell from $200 an ounce to $100 an ounce, a 50% decline in a 9-month time frame. The Fed, of course, lost its nerve with regards to higher interest rates because the U.S. economy faltered, and the voters bitched and whined. And that retreat by the Fed led to an increase in the gold price from $100 at the bottom to $850 at the top. I tell you that because the current malaise that we've experienced, as an example, in precious metals and precious metals equities prices, is one that is common historically. And while it's unpleasant, what it does is represent the opportunity to buy an underloved asset where the probability is that you're going to be rewarded. You don't know the timing, but the fact is, with regards to most things in life, you don't get both. You don't get certainty with regards to direction and certainty with regards to time.
I want to return to another point you mentioned a few minutes ago, which was about illogical circumstances. In 2019 and in 2020, in the discussions that we were having every Friday afternoon, one of the themes that came up as an illogical circumstance was the Canadian natural gas space. These companies were trading at easy EBITDA multiples of around 2 or 3 at strip prices at the time. This situation has changed rapidly as these companies are now in the 6. They're trading at multiples of 6 and 7, despite the fact that some of the catalysts that we discussed, like the LNG facilities being sorted out in Canada, they haven't been put in place yet. So in terms of illogical circumstances today, do you see similar risk-reward propositions in any sector, but in the gold sector in particular? Do you see such situations today?
I do, but I would say that the opportunities that are available today might be opportunities that are appropriate to a different style of investor or speculator. With the upside that was inherent in the natural gas market 2 years ago, that might have been more appropriate to a speculator, one who knew that the increase in price had to happen, but didn't know when it would happen, and was willing to speculate that the Canadian oil and gas industry would stay solvent until the price rose. This circumstance now is much less speculative, but is much more appropriate to an investor as opposed to a speculator. If the AECO price in Canada holds above $3.50 US, 1,000, the net present value of the reserves, and in particular of the resources, the proved, developed, producing, and the proved undeveloped, is substantially higher than the valuations that might be suggested on an EBIT to enterprise value basis. And the ability of these companies, if they chose to generate free cash after sustaining capital investments and return some of that free cash to investors, or use that free cash to continue to improve and increase the net present values relative to the enterprise value, is very, very, very high. Meaning that the sector that you speak about, in particular, the Canadian natural gas industry, has become perhaps less attractive to speculators who were asking themselves a when question, and more attractive to investors who are juxtaposing net present value against enterprise value. Still an attractive circumstance. With regards to the precious metals stocks, what we're seeing now is a circumstance where at least I personally believe that there is a probability that the metal prices trade higher for the reasons that we've talked about, but where certain classes of the precious metal stocks are historically cheap on the basis of net present value meaning the net present value of future cash flows at current prices and costs. They are substantially cheaper, I shouldn't say substantially cheaper, but they are at least as cheap and probably cheaper than they have been at any point in time in my career. Investors in this thesis and speculators in this thesis need to take into account the fact that the incipient inflation, which increases the gold price, will also increase the development costs of new mines and the operating costs in these mines. So it could be that there will be an evening out or even a reduction in the operating margins that these companies enjoy at current prices. But I, for one, believe that it's more likely than not that the prices of the commodity that they produce will increase too. And I should say, this is really going out on a limb, but for those people who are listening to the call who are speculatively inclined, and I need to say that I'm both a speculator and an investor, but those who are speculatively inclined need to begin to pay special attention to the silver market. I believe in the very near term the silver market goes lower because the people who I know who do technical analysis, I don't, I regard it as voodoo, but they're often right, believe that silver breaks down before it breaks up. But in my experience in precious metals markets going back 45 years, one thing that I've examined, that I've seen historically, and I'm not sure why, is that the second half of a precious metals bull market becomes silver-centric, not gold-centric. The precious metals bull markets are led by the fear buyer, which is a gold buyer, but they're driven, when momentum takes over, by the greed buyer, which is the silver buyer. in my experience, again, precious metals bull markets are long affairs, decade-long affairs. If you agree with me that we're perhaps 4 years into a bull market, if this bull market follows the traditional trajectory, we aren't even halfway through it. Dimension would suggest the same too. We've gone in the gold price as an example from $1,000 an ounce to $1750. And normally in a precious metals bull market, the dimension of the bull market is substantially greater than that. If I'm right in my thesis that we aren't even halfway through this bull market, and that momentum will reestablish itself as a consequence of the factors that we described earlier in the call, if history is guide, if past is prologue, the second half of the bull market will generate larger speculative gains in silver and more spectacular gains in the silver equities than in silver itself, simply because if the generalist money comes into the precious metals sector and tries to crowd itself into the momentum space, which is to say the silver equity space, there is insufficient market capitalization among reasonable quality silver companies to accept the amount of capital that will attempt to be forced into them. Much like you saw with the relatively small influx of capital that the uranium space has enjoyed in the last year, there was insufficient market capitalization among the junior uranium companies to accept even the fairly modest amount of capital that tried to crowd into them. The amount of capital which I believe will try to crowd into the silver space when silver begins to gain momentum will be a quantum larger than the amount of capital that tried to cram itself into the uranium space over the last year, albeit the total market capitalization in the silver sector is larger than the total market capitalization in the uranium space. But I think that the possibility exists that the circumstance that you saw among the uranium equities over the last year is a sort of a prologue for what you could see in the silver space. I'm not talking about anything that's going to happen, by the way, in 3 months or 4 months or 6 months. I think it's something that could happen in 2 years or 3 years or 4 years.
Yes, of all the groups out there, personally, when I look at the fundamentals of the precious metals market and I combine that with the tightness of the silver market, I certainly think for speculators who are not paying attention to that group, they should start paying attention there, especially given the malaise in the precious metals equities over the last little while. One of the questions I receive often, Rick, from both existing clients who are currently invested in uranium and folks that are reaching out to us is about valuations. And I'd like to end this call by juxtaposing valuations in uranium, in the uranium and the silver markets, which are both relatively small markets where capital flows tends to distort valuations beyond their fundamental intrinsic value. How would you recommend people think about valuations in these two groups today, where arguably uranium is, you could argue that they are overvalued already at current prices, and the same for silver. I think a lot of the equities there are not cheap, but they offer a lot of leverage as prices do move up. So how would you juxtapose valuations in these two groups today?
The difference is, first of all, that it's almost certain that the uranium price must go up. I think the silver price will go up, but I think the uranium price must go up. There simply is no alternative in the next 5 or 6 years for electrical supply that doesn't include a large uranium component. And without the uranium price rising, we will not be able to sustain the base load power that we enjoy worldwide. So while I agree completely, Aditya, with the thesis that particularly with regards to the junior uranium space, the share price escalations of 400 or 500% that we saw bottom to top means that at $45 a pound yellow cake, much of the sector is stupidly overpriced. I believe that the uranium price quotes are falling, and I believe, too, that an increase in the uranium price from its current, $44, $45 to at least $65, but much more likely $75, is something that will occur. So I think that there is a higher probability within the 2.5 year time frame that the uranium price goes up than the silver price goes up. I think, however, that the speculative impact and import of a possible silver price increase, particularly given that the silver stocks are out of favor while the uranium stocks are in favor, means that silver may be a better time-sensitive speculation than uranium. I personally, in the next 6 weeks, hope to be able to increase my position in both sectors.
Okay, I'd like to end the call today with an extension of this topic of diversifying across commodities in terms of constructing a resource portfolio. There's a lot of uncertainty in the markets today about the end game, including a potential crash in the horizon. There's a situation of negative real rates. There's persistent inflation. And then you have Powell, who thinks that this too shall all pass. So while there is no one-size-fits-all answer, again, I will ask this on a risk-weighted basis. What, in your opinion, would be a prudent way of addressing all of these uncertainties in the markets today in the form of constructing a resource portfolio?
Too many people who respond to my social media message are too speculative with regards to their portfolio. If I had a criticism of most of the portfolios that I've seen, most of the portfolios that I've seen overweight the upside relative to the downside. And I would like to see much better balance within the portfolios between investment quality themes relative to speculative quality themes. That occurs even commodity by commodity. Most investors are well underweight conventional energy because most investors either believe that the big money was made in the move from $20 a barrel to $80 a barrel, rather than understanding that the net present value at $60 to $80 a barrel is understated in the equities prices, and also because most investors don't value dividend yields as highly as they should, particularly in a circumstance where the return on cash otherwise deployed is so stingy that I think even after the increases that we've seen in energy prices, that both, particularly investors, but also speculators, have some room in energy, despite the fact that they don't want to be there. I think that there is an inevitability to higher uranium prices, and my hope is that the malaise that we're seeing in uranium, and in particular the malaise that we're seeing in uranium stocks, will take the path of the malaise that we've seen in precious metal stocks, because I'd like to greatly increase my position in the uranium space, given my belief that in the 2 or 3 year time frame that the uranium price goes at least to 65, probably to 75, and maybe higher than that. I love being asked questions where the answer must begin with when. I believe that gold and silver, the gold and silver sector, in particular the gold and silver equities, offer substantially greater value now than they offered a year ago or a year and a half ago, when everybody wanted to crowd in the space. How one constructs one's portfolio to take advantage of that really depends on one's needs. I think the mergers and acquisition theme is important there. I think that companies will acquire each other because scale means greater trading liquidity and hence a lower cost of capital, which is important in a capital-intensive business. Also, because it broadens the opportunity set available to a management team. and also simply because the exploration development pipelines of individual gold and silver companies are substantially constrained by 10 years of underinvestment in exploration development. The only way these companies can continue to grow is by acquiring assets and merging with each other. So I think that's a very, very, very important thing. But as I say, if I had to find a sub-theme that was attractive to a speculative audience, the two sub-themes in the precious metal space that are attractive to me from a speculative viewpoint are, first of all, the broader silver subject, where I think the market response to higher silver prices, and I think higher silver prices are probable rather than certain, but I think the market structure is such that the price response from the silver equities sector could be dramatic. I'm also delighted to see that the most precipitous declines in the gold and silver equities have occurred in companies that have a development stage projects, which traditionally I've loved, but they got way ahead of themselves in price, and also in the exploration sector. The exploration sector, aside from specific stock promotions, is absolutely anticipating failure. So people who can afford to risk substantial amounts of money need to begin to look at the exploration sector in precious metals. I'm not suggesting that that's appropriate for everybody on the call, and I'm certainly suggesting it isn't appropriate for somebody who doesn't have some technical knowledge or at least has access to technical knowledge. So perhaps the sensible speculation would be in the silver space. The speculation that has the best chance of having a portfolio delivering knock the lights out returns, albeit with special risk, would be the exploration sector.